Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and your host. Today we'll dive into the importance of knowing your investor personality and discuss how self-awareness can empower your investment decisions. In investing, this means knowing the answers to questions like, what is your risk tolerance? What are your financial objectives? And how do you react to market volatility? Your responses can reveal your investor personality, and this helps you work within your own behavioral and emotional limits and guides you to find information that supports rational decision making for you. A Harvard-based study found that while nearly everyone believes they are self-aware, only 10 to 15% actually are, so it's worth investing the time to improve self-awareness. In the investment space, if you're wondering where to start, begin by asking yourself, why am I investing? While all of us invest to make money and secure our financial future, there may be other underlying motivations. For example, an investor may be driven by the thrill of trying to beat the market, or having the bragging rights that come with telling friends about an investment that has doubled over the past 6 months. Broadly speaking, though, there are 3 types of investors. So first, and I think this is a large pool of people, are investors that really aren't very interested in finance or investing at all, but understand how important it is to invest to secure their financial future. Here, understanding the short and long-term risk-reward dynamics of different investments and how they interact can give these investors an edge. Investors can follow a simple strategy of investing in a diversified portfolio, adding investments over time, and ideally accelerating purchases when markets go on sale. This approach will work best only if the investor has a clear sense of their ability to handle short-term market swings and the discipline to stick to the plan. It may not be the most entertaining investment strategy, but it may actually be the most rewarding one over the long term. Now, for those who, in the second category, who are interested in finance and investing, but are aware of the challenges in trying to consistently outperform the market, a balanced approach is probably ideal. While they might find a simple buy, invest and hold approach too boring, it's wise to allocate approximately 70 to 90% of capital to a well-diversified investment portfolio across different asset classes with a long-term view. They can then use the remaining amount to pick stocks, sectors or themes to invest in. And the final category is the one that likes to pick individual stocks, hoping to beat the market. But these types of investors need to be aware that this approach is very risky. In fact, even the most experienced professional investors struggle to consistently outperform. Several investors make investment decisions based on short-term research and often skip deeper analysis or risk checks. And if you want to walk this path, then it's really important to make sure your investment choices are aligned with your risk tolerance levels and objectives. A lack of self-awareness can lead to unwanted risk exposures, misaligned strategies, and emotional decision-making. And this is especially the case for an investor who focuses on single stocks. So let me give you some pointers to get started on your self-awareness journey if you find yourself in this bucket. So first, assess the type of information that you're drawn to. Beyond just the basic snapshot of an investment, most investors tend to focus on price-related data. But this is only really helpful if you're a speculative trader. And even here it's ideal to consult multiple, diverse and reliable sources. If you're a long-term investor, then it's important to consider fundamentals, analyst estimates and risk metrics when you're evaluating investment options. If you think about it, long-term investing needs a front-loaded effort in terms of research, but less maintenance thereafter. For shorter-term investments, with more narrow investments such as single stocks, it's likely to be the reverse, as investments need to be actively managed, as the volatility of performance will be much higher. And we know that volatility often triggers panic or greed. So while you're researching the upside potential of an investment, please don't forget to weigh the downside risks too. That way, you'll be ready with a plan if things don't go as expected. It will help you stay calm, keep emotions and biases in check, and stick to a structured plan when markets get unpredictable. This can help you navigate volatility better and even seize emerging opportunities. Other tricks to consider include having some cash on hand for emergencies. This will help you avoid panic or distressed selling and enable you to shop for value investments. Continue to invest through downturns and accelerate your investments during these situations if possible. Third, keep an investment diary so that you can understand the thought process you had behind an investment and track its performance. By doing so, you can create a positive feedback loop to learn, reduce bias, and make more informed decisions and improve your financial well-being over time. Fourth, recalibrate your risk appetite based on your emotional response to portfolio losses. So if you feel that you've been taking excessive risk, then recalibrate and say, okay, I should be taking less risk. But as you do this, realize that when market movements are overwhelming you, you should reduce your portfolio risk exposures gradually instead of shredding your portfolio, which will be detrimental to long-term returns. So that's really what we wanted to cover today. In summary, self-awareness is a powerful tool that can help you navigate the evolving and complex investment landscape. Making informed decisions ensures they are aligned with your risk preferences and increases the chance of you becoming a successful investor. With that, we've come to the end of this session. Thank you for joining me. I hope you found the discussion interesting and insightful. If you're interested in understanding your investor personality, please head to the link in the podcast description. Until next time, take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.